Welcome back. This is a quick lesson on the perspective and situations where free cash flow valuation is appropriate. Let's jump in. Now that we've learned how to calculate FCFF and FCFE from the financial statements, let's learn how to use them for equity valuation. Actually, you should find the process familiar, as free cash flow valuation belongs to the class of present value models, much like dividend discount models, which sum up the present values of estimated future cash flows to arrive at an intrinsic value of the stock. Just that in this case, instead of estimating future dividends, we estimate future free cash flows instead. As we've learned in an earlier lesson, there are reasons to prefer to use free cash flow rather than dividend for equity valuation. The most obvious reason is that some of these firms pay little or no dividends, so it will be difficult to estimate and model future dividends. Also, as dividends are paid at the discretion of the board of directors, there could sometimes be no clear alignment between the dividend payout and the firm's long-run profitability. In contrast, free cash flow is less prone to management subjectivity, so it may be better correlated with long-run profitability in some cases. And lastly, the ownership perspective implicit in the dividend discount approach is that of a minority owner who has no direct control over the firm's dividend policy. As such, DDM may not be suitable if the company is an acquisition target. This is because the new owners will become controlling shareholders who have discretion over dividend payouts. In such cases, free cash flow approach may be more suitable, which leads us to a discussion on control perspective. FCFE can be seen as cash flow that can be redeployed outside the company without affecting the company's capital investments. Since a controlling interest can affect such redeployment, free cash flow valuation is appropriate for investors who want to take a control perspective. Free cash flow valuation may also be relevant for minority shareholders when potential exists for the company to be acquired, because the stock price should reflect the price an acquirer would pay. Now that we've made the distinction between dividend and free cash flow perspectives, let's discuss the distinction between FCFE and FCFF perspectives. FCFE, like dividends, are attributed only to shareholders, so the appropriate discount rate is the required return on equity, which is also the cost of equity for the firm. FCFF, on the other hand, is attributable to both shareholders and debt holders, so the appropriate discount rate is the weighted average cost of capital for the firm, which takes into account both the cost of equity and cost of debt. We've learned in Level 1 that the WACC is the weighted average of the required return on common equity and the after-tax required return on debt. The other key distinction between them is in the value that is calculated. FCFE, like dividend discount models, is based on cash flows attributable to shareholders only, so the present value of the cash flows is an estimate of the equity value. FCFF is based on cash flows to all providers of capital of the firm, so the present value of the cash flows is an estimate of the firm's value. In order to estimate the equity value, we should subtract the market value of debt from the firm value. Now let's test your understanding. Company A is expected to have a capital structure that's very volatile going forward. Company B has significant debt outstanding for the foreseeable future. Which valuation method is more suitable for both companies? Pause the video now and ponder over it. For Company A, FCFF is more suitable as the WACC is likely to be more stable than the required return on equity in a scenario where leverage ratio is fluctuating. This is because as the leverage gets higher, shareholders demand a higher return. As such, making valuation based on a constant WACC is more acceptable and accurate than making valuation based on a constant required return on equity. For Company B, FCFF is also more suitable. Having significant debt means FCFE is likely to be little, volatile, or even negative in some years. FCFF will likely be a better estimate as it is likely to be more stable and easier to assume a constant growth rate. The examples of companies A and B illustrate why sometimes we need to use FCFF model rather than the FCFE model, even though FCFF model may seem more tedious as it requires the estimation of the value of debt. And to end this lesson, let's discuss if there are good alternatives to FCFF and FCFE. You may sometimes be asked if EBITDA is a good proxy for FCFF and if net income is a good proxy for FCFE. After all, EBITDA is before interest payments and non-cash charges, so it seems that it's cash available to all investors. Net income is often seen as income attributable to shareholders, as it is after interest payments. However, the short answer for both is no, and it's not hard to explain why. Recall these equations from the last lesson. EBITDA does not reflect the cash taxes paid by the firm, and it ignores the cash flow effects of the investments in working capital and fixed capital. Net income includes non-cash charges like depreciation. Likewise, it ignores cash flows that don't appear on the income statement, such as investments in working capital and fixed assets, as well as net borrowings. These explain why EBITDA and net income are not good proxies for FCFF and FCFE. And that's our quick lesson on the perspective for free cash flow. In our next lesson, we dive into the main course of this topic, and that is the modeling and calculation using free cash flow models. See you again.